Good day, Industrial Advisor listeners, and thank you for tuning in. If you have not subscribed, please do so by clicking subscribe wherever you podcast. Click the like button and hit the bell if you want notifications of when we put up new content. Leave us a comment about anything we discuss here today or general comments about the show. Now, let's get into it.
Welcome to our Industrial Advisors podcast. You have Bill Condon and Matt McGregor, and we are doing today's episode on Q1 2024 review. We just got our numbers out. Been an interesting quarter for sure.
Yes, it has.
We've seen vacancy rise in every submarket except for the Eastside, which is interesting. So, talk a little bit about that and where vacancy is.
Well, before I dive into the details, we did hit 7%.
Yep,
okay.
right at 7. Vacancy overall is at 7%.
So when we hit 6, I called it a tenant's market, and you said no, and we debated here on air what a tenant's market meant.
Mm-hmm.
Is it a tenant's market at 7?
7% is, in my opinion, a healthy market.
A healthy market.
A healthy market for both sides. Now,
what's a bad market?
as we dive
I'm
into,
going to come back to this at some point.
as we start to dive into the numbers, and you look specifically at, okay, well, you know, like the 100 to 200,000 square foot market is vacancy rate is up there.
Is that a tenant's market or a landlord's market?
That's we're counting that as we're showing that as a little over 9% vacant.
Yeah.
That is a tenant's market. So, well, there's a lot of options in that size range, right?
Yeah.
So
for the listener, it's definitely a tenant's market. Now remember, Bill is Mr. He would, if we were 11% and buildings were falling down to high winds, he'd still say it's an excellent market.
I would say I will tell you the Kent Valley is the best market in the country.
See?
So
we're not going to get this out of him.
Anyway.
So it's officially 7%, I would say. If you brought in 100 brokers in this room, you might be the only one that says 7% is not officially a tenant's market.
There's a healthy equilibrium right now in the marketplace. So let's jump into some of these submarkets. So looking kind of close in, South Seattle, right? That is at 8% right now as a submarket, 8% vacant.
That market continues to hurt.
Yes, there's not been a lot of movement in that particular market other than, vacancy has gone up a bit. And it's a pretty slow market there right now. And that has not changed, I would say, over the last 12 to 18 months.
No, there's been almost no movement there.
Kent Valley's an interesting one.
It's climbing.
Yeah.
Unfortunately, second highest vacancy in the market now at 7.5. I think a lot of that obviously is due to give back subleasing.
Yeah.
So that's certainly been impactful. And then Pierce County, I mean, you can call Thurston County the lowest, but there's not much product there, right? So out of the saturated markets, Pierce County is the lowest at 6.6, which is interesting because that's also where all the product's getting dumped on. Yeah. Right. So I would say that's a pretty healthy market because part of that 6.6 is new product, right? That's accrued in this number. Yeah.
I think a couple things to look at there when we look at the Kent Valley and in Pierce County. You look at the Kent Valley product, a lot of that product is in that 100 to 200 range, right? I mean, that product was kind of built like that over the 80s, 90s, early 2000s. Whereas as things got developed and pushed south, that's where the bigger product went, and that's the stuff that's getting absorbed right now.
That's right, exactly. And then let's, historically, just to put it in perspective for the listener, the last time we hit a 7% market, the market was actually coming down, and it was at the highest vacancy in our careers was 2010 at 9.2%.
Mm-hmm.
It started heading down in the third quarter of 10 after, it got hit in late 2008, and it started recovering at the end of 2010. And in 2011 was the last time it was 7% equal to what it is now. And then it slowly just went down 3.3 during COVID.
Yeah.
Pre-COVID 4.9. And now it's shooting up pretty quick, quarter by quarter. This quarter was over 100 bips.
Yeah.
So that's a lot. That's a lot of movement in one quarter.
Yeah. It's interesting when you look at the last time you mentioned, 2010, 2011 is the highest vacancy that we had. We also recovered really quick. Like we were one of the
faster
first,
than anybody.
Yeah, one of the safest markets in the country, quickest markets in the country to recover from a tenant standpoint, from a dropping that vacancy standpoint. So, yeah, it's an interesting time right now because through Q1 we have a higher vacancy that we've seen. Now,
do you guys hear that? Bill is we're still heading up, and he's already calling for recovery.
Yeah. Well, it doesn't seem so. When you think about it, there's kind of been three since we've been in this business about the same time, 20 years, right?
Yep.
When we got in to the business around 2004, the vacancy was similar to probably what it is right now, right? And that felt in 2010 as well, 2011. It felt like then in those two time periods that it was much more of a tenant's market, and landlords were getting more and more aggressive to go get deals.
For sure.
Than it does right now.
Yeah, I remember painful vacancies on listings back then.
Yeah, I think part of that probably has to do with the fact that we're a much more mature and deeper market now, right? So we're bigger, we're more corporate. And so I think that's the big part of it. Whereas back then, there wasn't nearly as many institutional owners either, right? There was a lot of private owners that would go just want their buildings to be full.
That's right. And geographically, it was a much tighter market as well.
Yeah.
Kind of Indian Sumner, although obviously you had your product in Tacoma, but it was different type of product than it is now.
Yeah. Yeah, and just overall, let's talk a little bit about how, because we're obviously very active on the tenant side and the landlord side.
Mm-hmm.
The user side, tenant side is much more cautious right now. Would you agree with that?
Well, they're in retraction because we're all buying less durable goods, right?
Yeah. So talk about that. Expand on that a little bit.
Yeah. Well, I mean, in COVID, no secret, we were all at home and we were buying stuff to fix up our gardens and pets and pet supplies and staycations and winter vacation, all of the junk and new barbecues, everything around your house. So everybody was bulking up on massive, massive supply chain, right? For this, and the buying patterns were all on durable goods. End of COVID hits, everybody's buttoned up for 2.5 years, and now they want vacations, right? So you remember last summer we saw the first turning tide of that, where Walmart got stuck with all the lawn chairs and barbecues, and a lot of people continued the forecasts of COVID sales past COVID, which is interesting, and a lot of people got caught. And so I'd say everything around the home got hit pretty hard because people don't want to be in their houses because they were there too long.
Yeah.
So you can look at the TCUs in the port system and, across the board, they're down, right? And for the most part, all over the country. And so we're just buying less stuff and using less warehouse space.
Yeah. And then I would just say within our, the 3PL world is a big part of our tenant space, right? And we work with a lot of 3PLs, and we have multiple subleases out representing 3PLs that are looking to kind of backfill maybe space that they don't need right now. So
and there's not a lot of bids, right?
That's right. Yeah, there's a few out there, and you're also just kind of seeing not as much. A 3PL in the past would go take extra space, knowing they'd grow into it. Now they're kind of taking the space that they need if they need it at all.
That's right.
Yeah.
I mean, if we want to take it a little step outside of our market, just briefly, I mean, a lot of the growth is in manufacturing, right?
Yeah.
Right. So traditionally, we've been a distribution market for, better part of 25 years when we shipped a lot of stuff overseas for manufacturing. A lot of that obviously is coming home, some in Seattle.
Yeah, which is good. I mean, there's good news on that front.
Absolutely.
Yeah. You want to talk a little bit about investment sales? I think that, we've done, there was, call it 6-7 deals done in the south part of the valley. We were involved in the majority of those. Good news on that front. It was a mixture of investment sales from investors, but also a couple nice user sales as well, which, I think it speaks good to the user market and user demand out there. But we're starting to see, we're getting a lot more calls from investors that are saying, hey, we're ready to go again, right? I mean, it was so quiet last year on the investment front. Now there's starting to be a lot more demand, which is good, from investors saying, hey, we're ready to go. I think part of that has to do with us being in the Puget Sound, right? And being one of the better markets in the country, a safer bet for investors. But it was an okay quarter, and we were involved in a lot of those sales. And I think we saw that there was multiple bids for the first time in a while on a lot of these deals, which was good.
Yeah, I agree. Although I 100% agree that investors are back traveling in our office, underwriting stuff, making offers. The users are there.
Yes.
Right. So in Q1, which historically speaking is always the worst quarter.
Yeah.
Right.
Ramps up as the year goes along, obviously.
Yeah, it was a decent quarter with, 12 transactions, including the North and Eastside, right? If we just do the Kent Valley, so let's just talk about that for a minute. It was 7 transactions, but 5 of them were users. Investors competed on all of them, right? And the users won out 5 out of 7. This is the best opportunity for users, I would say, since the 2005, 6, 7 time period. Because, I would say, sorry, I take that back. 2008 through 2011 when the investors were out.
Yeah.
So, and then investors started getting aggressive, dipping all the way down to 25,000 footers, which had never happened, pre 2010. Right?
Yeah, right.
It never had happened in that more aggressive cycle from 2005 to 8. Investors used to kind of cut it off at, kind of 20 million, 20 million. And so they started dipping down. I remember selling DCT a building for 2.2 million.
Yeah,
right?
Next to one of their big ones.
Yeah, exactly. But so the users just couldn't compete for, better part of a decade, right? And now you look at this first quarter and we sold a few of these and boy, the users were out.
Yeah, but to your point, it's a really good point that you made. They're back because there's opportunities. So, when cap rates were 3.5% to 4%, investor pricing was all of and maybe more aggressive than user pricing. Now we're back to the days of users being able to pay more than investors because of where debt's gone.
That's an excellent point. And I would also say that during those times, even if a user matched pricing, the risk of going down the road with the user because of their financing and whatever, just not the sophistication of an institution. Now, I think some people look at it and like, buyer interviews are real this time. And you're saying, what's your approval process for real?
Yeah.
And we really want to know.
Yeah. And it's been nice on the user side, though. Everyone's performed.
Yeah.
That's taken a building under contract that we've sold.
Absolutely.
And we have another one under contract, too,
That's
in
right.
Tukwila. So, and that buyer looks strong.
Yep. Yeah. So it's been nice to see the users back out. But I agree with you that the investors, for a long time, our phones weren't ringing, right? They just pencils down for the most part, right? With some exceptions. But now, our phones are ringing every day. People coming in the office, underwrite, making offers. Certainly, they're not competing on pricing exactly with the users, but they're out there. We're seeing a lot of offers, and I expect the rest of this year to be nice recovery for capital markets, no doubt about it.
Yeah, way higher than last year, which isn't saying a lot, but significantly higher.
Yeah,
we're getting more BOVs. We're doing more BOVs too.
No doubt about that.
Which is helpful. So let's talk multi-story product. There's still, the 3 deals in South Seattle that are up.
Yeah.
Talk a little bit about what you're hearing on activity from the multi-story side.
Yeah. First of all, as we've discussed, we did a multi-story podcast several weeks back. Really liked the Crow asset. I was super optimistic that they would lease that. I didn't call them for this podcast, but I've not heard of really strong activity on it. I still think that thing's going to lease up, but that's still available. Yeah. And I think the ones that are really struggling are Track 6 and Horton. I think that's a different product type, obviously.
Yeah.
From what I understand, there is some activity at Track 6.
Yeah, which is great.
Yeah. I don't know that there's any activity at Horton, but overall, the multi-story is really struggling.
Yeah, it is. Now, that's all location driven. So, there's not that's a 8% vacant market. So, that's
and when they were underwriting that stuff, it was probably 2-3.
Yeah, it's definitely come up. 700,000 square foot 2-story building's the only one in town, right?
Yeah,
so it just takes one.
That's right.
Yeah, it just takes one there. So we'll keep a close eye on that, and specifically that South Seattle market. Seems like Amazon's coming back.
Speaking of the
market.
one,
the one,
the one, Amazon it seems like they're back. Understand, obviously, this is all industry rumor, but understand they're looking to ink 3 large deals in the IE. They were active up here, I think, for a 1 million footer. I was hearing this morning maybe that's not on, but I don't know for sure.
Yeah.
But I do know they were somewhat active for a 1 million foot up here. And then I believe they have a lot of deals in the pipeline, a lot of very large deals. I heard a number. I'm not going to throw it out here, but a lot of deals that'll be coming online.
Yeah, I mean, I would imagine they'll come back. It's funny because we used to track, largest occupiers nationally, right? And who leased the most space. And, they'd be upwards of like 80, 90 million feet. And, a year, years ago, 4 years ago. And I think last year they were closer to like 12 or something like that.
Yeah.
So, but they'll, I'm sure, come back. What are you hearing on Boeing? I mean, Boeing's been super active in our market.
They've been very, very active over this past year, taking down a couple of million feet, really the first time in our careers, right? They gave back space for 2 decades. And now they've, we don't represent Boeing, so we don't know exactly what they were doing, but I think it was a move out of China to some degree and taking down some space, and took down a lot of space in the Kent Valley. We understood they were taking down some more space at Fred 310. We have heard a rumor that may be on hold.
Yeah.
Yeah.
Yeah. I mean, they've leased a lot of space. They've been helpful
for sure
for the market.
Well, when Amazon disappeared last year, thank goodness for Boeing.
Yeah.
Right? Because they came in and saved the day from an absorption standpoint.
Yeah.
They really did.
Yeah. No, we were happy they were active.
We're all pulling for them to come back and take down Fred 310.
Absolutely. Talk a little bit about the port activity and where we're at on that.
Yeah, kind of going back, the overall port activity and supply chain issues this year got very complicated yesterday, unfortunately, due to the bridge collapse in Baltimore. As we all know, that scene was horrific, but let's just talk about it from a supply chain perspective, because, man, something like that happens and those cargo ships can't go in there. That was our 10th most active port by TEUs. And so, that was a significant port. And so all of that freight is being diverted to other hubs up in other ports on the east side. But that's complicated because now you drop that stuff in, New Jersey or Savannah, you drop that stuff, they don't have a warehouse for it there.
Right.
So now you're trucking it, your delays. Some of it could be perishable.
Yeah.
I mean, you're talking about a lot of stuff, and that port is just not usable right now.
Right.
I'm sure when they clear the bridge out, who knows how long that's going to take, that the port will be usable, but now you don't have the bridge, right? So that's a significant change in the port system in the U.S. It's a massive issue on supply chain that's going to take months to unfold, if not longer.
Yeah, and a lot of those surrounding markets where they would get that product would go to now, that's not usable. They're, to your point, really tight markets.
Yeah.
So there isn't a lot of space that they can just go take down.
That's right.
So we'll keep an eye on that for sure. Kind of bringing it back to our market from a development standpoint, we're not overbuilding right now. Our numbers show that we have almost 7 million feet under construction, of which about 4.5 still available. We typically take down a little over 4 million feet of absorption a year. So, we should, in the next year or so, absorb most of that if we stay true to what has historically been the last 3-4 years of absorption.
That's a good way to look at it. You were right on the 4 million, but as you know, if you take out COVID, right, and we're not going through COVID again.
It's closer to
It's closer to just under 3 million. And so 7 million feet is a lot of product coming online to a market that if we just say, hey, it's going back to 3, that's a good amount of supply, and we're already at 7%. And so, hopefully the big box market, which has really been saving absorption, will continue, because we got a problem, as we know, when we beat this to death in the 1 to 200,000 range. It's 9.2% vacant.
Yeah, something like that.
Yeah, with 51 options. But a lot of that 7 million feet is big box stuff that has been absorbing quickly.
Yeah, that's the thing that's really helped us. And I think if you look at the market and kind of what's rumored to be out there are a handful of deals that are 400 or 500 and above that are out running around that'll, with big names that'll hopefully land. Yeah,
there are several deals. So, I mean, out of those deals, and certainly if Amazon, hopefully they didn't disappear, but if they're out there, yeah, you're right. You could have, just in the deals we know about, 4 or 5 million feet of absorption.
Yeah.
And hopefully that happens.
Yeah.
But what we need is a middle box market, right?
Exactly.
Take down some of that product, because that's just a building inventory and people keep building it.
Yeah. Yeah. No, we've always said you can tell a lot about a market by how just the mid-level is doing, right?
Yeah.
And so we're struggling there, but hopefully we'll see some activity Q2 on that. So that's our Q1 recap. It's going to be a fascinating second and third quarter from a tenant velocity standpoint. I think on the investment side, we're going to see a lot more action there. The tenant velocity will be the thing I think that's most interesting to watch.
predictions on what will happen with vacancy and investments in Q2? Did 111 million in investments in Q1.
Yeah, I mean, there's a couple deals that we know of that'll trade. So I think it'll be slightly more than that, and then the second half will be significantly higher. And I think that towards the end of Q2, we'll see a couple big deals ink on the leasing side.
Yeah. I think we'll probably jump up to 7.5 before it stops and starts going back the other way, just because of product coming online.
We'll be down to like 1% vacancy by like July. We'll see.
That's right.
There we go. Well, it'll be a great quarter to pay attention to, and we'll look forward to doing our Q2 recap here in a couple months. Thanks for listening.
That's a wrap. Thank you very much.